Rana Gupta is now with us, Senior Portfolio Manager, India Equity Specialist at Manulife Investment Management. Rana, good to have you with us here. I don't know if you own IndiGo, but talk to us a little bit about how an institutional investor thinks about something like this. I mean, a situation like this. Dominant leader, and of course, I mean, a lot of the criticism is for the dominant market leadership. And of course, I mean, the fact that because of its dominant leadership, there was so much pain and suffering all around for customers and flyers. And there are some remedial measures. How would you take a look at the situation? Would you say this is a great chance to buy, or would you say, there will be now measures over a period of time, not immediately, to encourage more players and kind of, reduce the over-reliance on one player? What's your sense?
Good morning. I think what happened to IndiGo, I think taking a step back for investors is very important to understand the revenue and cost dynamics. If I look at this situation, what this airline in question has to do has to either cut capacity or increase staff. Either way, either the revenue per seat kilometer will perhaps trend down, or cost per available seat kilometer might go up. As of now, because its events are still very fresh, one does not know the impact that it will have revenue minus cost per seat kilometer. That multiplied by the seat kilometer is basically the profit of an airline. So right now, there is not too much of clarity. We know direction is trending down quite a bit. I mean, there are news reports out saying government has asked 10% route cut. There are news reports saying that the airline in question has to hire 10% more pilots. So one has to wait and see how this revenue and cost equation settles. Before that, I think taking a call on this is very difficult.
The way you rattled off all that formulae, it looks like you've done the numbers. Am I wrong, Rana?
No, we of course run the sensitivities, and we look at sensitivities, but these are sensitivities. These are in an Excel sheet. We need to see how the numbers play out when the dust settles.
Rana, hi, morning. This is Rima here. On quick commerce, in the past you've said that you see long-term opportunity here. But the landscape is shifting. Companies are building a war chest, and it's large. And if the attention next year shifts to growth over profitability, and profitability timelines get pushed forward, the focus is on market share grab, how will investors read this? Will this be share price negative? Is there a possibility that quick commerce companies like Swiggy, Eternal come under pressure next year, and that could be the buying opportunity?
So I think quick commerce companies have already come under quite a bit of pressure in the last 3 months. The stocks are down quite a bit, actually. And we continue to like them longer term. To our understanding, that the one company that raised capital, they have still continued to guide towards a break-even sometime middle of next year. Now, I think it is very important to understand that not to track just the discounts. In fact, our analysis, bottom-up study of all this quick commerce and the dark store suggests if the discounts are building long-term customer repeat orders, then it's might as well worth it, because slowly but surely, because the asset turn goes up, you can sell more and you acquire more consumers. It is beneficial for the longer term. So while this happens, the war chests build up, and there are some short-term and medium-term concerns and competition. We remain very optimistic on the long-term outlook of quick commerce. It's a market with huge addressable huge TAM, and there are 2 or 3 dominant players emerging. So as such, we remain quite bullish, and the correction that has happened in the stock prices reflects the concern that is out there. And I would say on the profitability, when the dust settles on the growth and market share grab, we remain convinced that profitability swing will be quite rapid. And if you just look at, let's say, some of these companies, they release detailed shareholder letters quarterly. If you just look at their stores that they has opened a year ago, their profitability, and then draw the similar kind of math that stores they're opening now, even if they reach half of that kind of profitability 1 year down the line, the profitability math will become quite clear to everyone. Right now, there are concerns, I understand, but I think as the stores mature, profitability is going to improve.
So buy at this juncture?
profitability improve, I think it will take another because because the one company has just raised money, and we hear that the third player is also coming to the markets. So I think you have to give it 2 to 3 quarters, but within that, I think profitability will be quite apparent, at least for the larger players.
Okay, all right. So you're sounding reasonably optimistic if you have a longer term horizon. Got that. Rana, good to see you in as always, Rana. What about the other big theme, EMS? They were trading at very, very high valuations, but there was not too much concern because people said growth will be there. Now suddenly the focus has shifted from solely depending on growth to what about the cash flows? Some of them are negative. Receivables as well had spiked up. After the correction that we have seen, do you think some of these EMS companies are coming to a level that you'll be interested, given the kind of growth outlook that we have out there? Your take?
Sure, no, that's a very important and relevant question. So we are always enticed by EMS growth, but at the same time, the cash flows are also very important to us. In fact, a company which is growing very aggressively with low margin and high working capital is something that should always be avoided. And I can share with all of you that if you just study the balance sheet of any company and see that the net worth is represented by mostly 70-80% by the capital raised from the investors, then I think you got to have better check the balance sheets well and understand the business well, which means the company's net worth is basically funded by investors, and the company's PAT is not really adding to that net worth per se, because everything is invested in your inventories and debtors and whatnot. So the cash flows have always been important to us. So therefore, I think the point is that because the growth is there and the companies which can manage their cash flows, for example, let's say there is one company who has a very strong business in something and reinvesting their cash flow to ramp up the EMS business, that is something we would be actually quite positive on. In fact, those stocks have fallen because in sympathy, and we believe that the longer term, with keeping the longer term in mind, these could be actually quite good opportunities. It can take some time for the doubts to gradually clear away, but I think two things should be remembered. Number one is the broad goal that electronics production from $120 billion in this year is going to grow 3 to 4x by 2030. And the leading companies, which has a strong balance sheet and good cash flows, is going to take a majority share of it. So that is something I think we should remember. And of course, one or two companies will mismanage their balance sheet. That does not define the EMS trend that we watch.
No, that's well put. And I think that's sound advice for viewers and investors out there, how to kind of sort of look at some of these companies. One of the basic ways to look at some of these companies. Neogen, I'm just highlighting a bunch of names which were not in the mix in the morning at open, but 7% on Neogen, so 1,058 coming through here. There's Keynes is up 2%. It had a 10% flip-flop over the last 2 days. BSC lost about 4% yesterday. That is up about 2% right now. And so it goes. I mean, volumes are thin, very, very thin still. About 1,400 down, 1,100, actually 1,200 stocks are higher. So it's not very, very, it's not very disbalanced. It's kind of evenly matched at this stage. Some of these, we talked about quick commerce earlier, Rana, but, names like Meesho, which came to the market. And actually, on this one, what's your view?
So,
okay, here, let me preface, right? We spoke with a company and they said, well, focus on their number one metric is free cash flow. And they are saying that we will generate tons of it going forward. And that's how you should look at us. Go on.
No, I think that's, like I said, that the cash flow is always a very, very important metric. It's equally important for us to understand the cash flow is coming from where. Is it about the company's pricing power, or is it about efficiency operations, or it's a combination of all the factors?
In this case,
in the question, I think they have gone out to say to investors that they do not charge their consumers or sellers. So if a company is not charging the consumer and the sellers, then the profit has to come from logistics. Now, logistics in this case is open sourced. Of course, they have done well so far. Now, the companies, I think the net market value that they reported should be about 30,000 crores odd, supposed to go at 20-25%. So this number in 3 years will be, if I just take that math, that probably 60,000 crores and then 1 lakh crores and whatnot. Now, the key question for us is that can a open source logistics support such high turnovers? Now, today we cannot say with clarity. Maybe we need to understand this a bit more better. But it is important to understand in this case, the logistics and the ad revenue, or rather the videos the influencer put, are the main source of revenues. They are not charging the consumer and the sellers. This kind of business model, which we call social commerce and all that, has existed in other countries, in China and also. So I think we will require some more time to understand that how it can scale up in India.
The content-led sales already hit, I think, on an annualized basis, 1,200 crores. So let's see whether that turns out. But the management said that at least on advertising, that is a lever because their ad revenue growth is less than what you have in other markets. So that's one lever that they would like to pull. Of course, the big one is logistics. Rana, thank you very much for joining us today. Great conversation. So many numbers you've shared with us and a way of thinking about valuations and analysis of companies.